All right. Ended up having to change computers here, and my other one burned out. That's why this video is split into two. Just talked about academics versus gurus, and the difference between those. And I said for some of this, I'm going to speak as a guru and sort of just tell you one best way to do some of this stuff. Now, we get into the textbook way of managing money. And one of the things that somebody, I think, asked on a blog or on the discussion post was how to reconcile a checkbook. And I uploaded a video from Frontier Bank that goes through the process of actually reconciling and balancing a checkbook. The reason I don't teach that here, and the reason I don't teach that in class, is only about 20% of people actually balance their checkbook. And there's some research from some mainstream economists that suggest it's far less than that. It's something like 13%. And if you really get into doing it correctly, it's even less than that. So that's why we don't go in there. And one of the reasons I don't get into it again is I don't actually balance my checkbook myself. And I'm going to tell you a little bit about a system that I use that actually a lot of students use some form of that system. First thing I have is what's called a mint.com account. You may have heard me talk about that before. And a mint.com account is a little like Yahoo email or Gmail, where you can have this system online. It's on the internet, and it houses all of your financial accounts from different financial institutions. So that's the first thing I do, and it has neat functions on it. One of them is it will split up your transactions. So if I go to Hy-Vee, Mint.com knows that I'm getting groceries there, where if I go to Walmart, I have that classified as getting household items and have it a little bit different. And then what I can do from there is actually create a budget and then employ a budget, and the Mint.com will keep track of that and tell me if and when I go over budget. So that's kind of one of the systems I use as opposed to having a checkbook and doing all this manually. And again, one of the reasons I do that is, in all reality, my wife and I are very busy people, and we're not going to have a checkbook and a check register when all of this information is tracked electronically via online banking. In fact, most students, there's a number of them when I ask for a raise of hands in class, how many of them write checks, and I have probably about 50% of students say they don't have checks and they don't even have a checkbook. So then I ask them, well, how do you figure out if you have enough money to cover the transaction? They say they just go on their smartphone and look up the balance in their checking account. So that really is how we're doing this more so, and it's expected in about 10 to 20 years we'll actually do away with checks, and everything will be some form of electronic transaction. There are a number of countries, I believe now, that don't have checks. They've gotten rid of them entirely, and they just use electronic forms or electronic transactions. So at some point we'll expect to do that. And as electronic real-time transactions or ACH debits take the place of checks, the more that happens, the less important it is to balance a checkbook so you can figure out what your balance is. Now, reconciling a checkbook, the purpose of that is simply to figure out how many outstanding transactions you have. 10 years ago, if I went to Walmart and I swiped my card to pay for something, Walmart would send an electronic file that could take anywhere from a day or two, and over the weekend, the entire weekend, it might take until those transactions would hit my checking account. In this day and age, those systems have been updated, so most transactions are real time. In other words, once I use my account or use my debit card at Walmart, about 5 minutes later, that'll hit my bank checking account. So worrying about that float time, and that's what you're reconciling for, has become less important. In order to manage that float time, though, something that my wife and I do and a number of bankers did when I worked in banking, and I've actually had a number of students do this same thing, is they have two different accounts. They have a checking account, and my wife and I have a checking account where all our money, all our income goes into that account. On the other checking account, is an account we actually draw checks off of. We keep a minimum balance of $50 in that account, and it's always at 50. And the reason we put a balance in there at all, or put any money other than the amount we're writing the check for in there, is so that in case something kind of gets screwed up, or something on the check gets written down incorrectly, or the person depositing it takes it as an incorrect amount, there's a little money left in there to cover that, and so we don't overdraw our checking account. So again, we use multiple checking accounts, and then we don't have to reconcile our checks. My wife can simply go into that one checking account and look to see what checks have been drawn off that. And what she does is, if she knows she has to pay the utilities and the utilities cost $372.85, she will transfer from our main checking account via online banking into that other second checking account for that exact amount. That way we always know there's $50 extra in there, and the ending balance should be $50 exactly. So neat way of kind of managing this stuff. And as I said with mint.com, then we can budget electronically and automatically. We don't have to sit here and mess around and put a lot of extra time and effort into something when you don't have to. Now, I always have students say, well, I don't know if I trust these websites. And I would offer up that from a statistical perspective, from a consumer fraud protection perspective, and actually from a friend of mine who's a corporate security director at a large bank here in Brookings, from their perspective, you're far less likely to become a victim of identity theft from a huge website like mint.com than you are from somebody stealing your mail and pulling out a statement that has all of your information on it that a person can get, and then try to borrow money electronically or through other forms, or get a credit card in your name and do that. So the other is, if a company like mint.com didn't have safeguards in place, they would have been out of business many, many years ago. So I'm not saying it couldn't happen, that website's information could get hacked and somebody, fraudsters out there could get that. But what I am saying is they have to put a lot of protection in place to protect people's IDs, multi-factor authentication, and other types of things. So I'm comfortable using it. If you're not, please watch the video on reconciling your checkbook that I've put in the content if you're interested in learning more about that. All right, now we get into this personal income accounting cycle, or personal accounting cycle. Really how this works, a little like a bank statement, and I call this the old-fashioned way of saving money and how the whole system works. And how this works is you start off with an income statement or income and expense statement. We see that here up top. You take all of your revenue or your income, and throughout, let's say, the month, you subtract all your expenses. Any amount that's left over, imagine that going into a savings account. Okay, so again, the bank statement, any remaining money that you have there, take that over, put it in a savings account. Once it goes into that savings account, I say it becomes an asset, okay? Because you're not drawing checks off that money and you're not spending it. You're just setting it to the side right now. You take all of your assets, so any personal assets that are of marketable value, investment accounts, savings accounts, 401k plans, those types of things, and we subtract our liabilities or loan. It's what you owe. Once we subtract liabilities from the assets, what's left over is your net wealth, or net worth, your wealth, your equity. And wealthy people focus on that number more so than all the others because their goal is to grow their net worth. They want to grow their wealth. Now, the reason I say this cycle is old-fashioned is because 50 years ago, this kind of is how it worked. In this day and age, when you are required to save for your own retirement, you don't have the traditional pension plan anymore, we have a little bit of a problem that you need to be funding that and paying for that first. And when you do the benchmark exercise, we'll see that's something you want to take out and budget for right away. So knowing that, what most employers will allow you to do is to deduct an amount of money, a set amount of money, to go into a 401k plan. Most financial advisors will recommend you save a minimum of 10% of that income to put into your 401k. Now, the principle of taking that out right away is called paying yourself first. Okay? If you ever read that in a magazine, a money magazine or something, that's what it means, is we're paying ourselves first. And in this day and age, that's much more the fruitful way of making sure you're saving enough for retirement. So, but we need to understand this old cycle and this old system when we're reading other text, that's kind of how the cycle works, and just so we have a general understanding of it. All right, on the income statement, a personal income statement, we have salaries and wages, bonuses and commissions, and those are all classified as income. Then we have expenses, fixed expenses and variable expenses. Now, a fixed expense would be like a cable bill or your rent payment. It's the same every month. A variable expense is one that fluctuates. Good example would be the food or eating out. Hopefully those are sort of fixed in that you budget for them, but many people don't, and therefore it'll fluctuate from month to month. Your utilities are also variable. And again, this is what an income statement ultimately looks like. We have our income, you total that up here, and then you total all your expenses, and what's left over is your net income. Then the balance sheet keeps track of all of your assets and liabilities, and when you subtract liabilities from your assets, you're left with your net worth. The assets that you own that have marketable value, I would call those actual assets. There's a lot of personal finance text that says those aren't assets. And the reason is because, let's say like your computer, you could go out and you could sell your computer, but are you going to go out and sell your computer if times get tough? And odds are you're not going to, because in this day and age we need computers to survive. Your employer maybe emails out things to you. If you have children, a school is going to email out stuff to you. So you need to have that. Then we have liabilities, and another way we can think of liabilities is loans. This is what you owe. So when you hear liabilities, think loans. Any loan from a bank, any loan from a car dealership, again, is a loan. Student loans are those. And this is what a balance sheet looks like. We total our assets, and then we have our liabilities. We take our assets minus our liabilities, and we get our net worth. Now, many of you, especially if you're in that range of 20 years old and you have student loans, may have a negative net worth. That's fairly normal, typically, again, because of student loans. But once you're in your 30s, probably mid-30s, we hope that number changes and it becomes positive. And the younger you are and the more positive that is, the better off you are. So, again, it's not abnormal to have a negative net worth at a younger age, but we do want to make sure that somewhere in your 30s that's becoming positive. Now we're going to play a little bit of a game, and we're going to go through it quickly. And this is to help you with your midterm and final exam. I'm going to list an item up on the PowerPoint here, and you're going to guess if it's an asset, a liability, income, or an expense. And on your midterm and final exam, you're going to get about 6 of these ones from this exercise, and you're going to have to tell me what it is. So, first one is a house. And a house is an asset. A lot of people don't know that homes are actually depreciating assets. We say property is often appreciating, and in part because of the land it sits on. Land we think of is of an appreciating asset in large part because they're not making more of it. So it's probably always going to go up in value. I say probably. That doesn't mean it's always going to go up in value, and there are such things as land bubbles. Right now in South Dakota, agricultural land is thought to be in a bubble, and maybe at some point that bubble will burst and those prices will go down. Salary is income. Cash in a savings account for the purposes of this class, we're going to call that an asset. And really, you'd call that an asset either way. A credit card, remember, liability, loan. Bonus money, income, taxes. We're going to call those an expense because you really don't get anything back for your taxes. Now, I know some people would argue, yes, you do. You get maybe schooling or education that's paid for through the government and other things. But for our purposes in here, we're going to call it an expense. Food would be an expense. Tuition is also an expense. You don't get anything directly in return for that, and you do get a degree, but you can't sell your degree to anybody else. So again, we call tuition an expense. A vehicle is an asset and it's depreciating in value. Land is an asset typically thought of as appreciating. Mortgage loan, liability. Personal property that can be sold and has tangible value, we would call that an asset in here. Student loan is a liability. Medical insurance payment, it's an expense. Typically, it's a fixed expense. Telephone bill, an expense. Clothing, an expense. Now, could be argued that some clothing you could sell it and it would have some marketable value. But for the most part, you're not. If you are going to get money from selling your clothes, you're probably not going to get a lot. Entertainment is an expense. Gifts are an expense. Now remember, your net worth is assets minus your liabilities, and it's the number most wealthy individuals focus on increasing. Increasing your income alone does little good if you're failing to accumulate some of it, and that is not uncommon. There are many people that earn six-figure incomes, but they don't accumulate any of it, so they never really become wealthy. All right, now managing income, and when you get into the Project One portfolio, you'll go through a process of comparing things. But what we're talking about here, and this is kind of a term I coined, is we're trying to figure out the value of a combination of benefits you receive from a job and the base pay. So, for example, you could apply for work at an organization that pays a very high salary, but doesn't have any insurance, and you might be required to live in Beijing. For some of y'all, this would be wonderful, but for others, including myself, this would be a nightmare. I don't want to live in Beijing. Well, I shouldn't say no matter how much money I earn. I suppose for $500,000 a year, I would be willing to live in Beijing without any insurance. But again, for a lot of people, that's not what they're going for. So, and maybe they want benefits, such as health insurance, 401k. In other words, what we want to do is try to take into account all of this information when we're trying to decide where we want to apply for jobs, and to figure all this out so we can quantify it and compare apples to apples and oranges to oranges. Now, for your project portfolio, your first project portfolio, we're going to use a CBS salary calculator in order to find a plausible starting income. We're also going to use a cost of living calculator to contrast and compare different places to live. You might be applying for an occupation as a nurse, and that may require you have to move. So those are the things that we're going to look at. And how we decipher this is on this cost of living calculator at bestplaces.net, the national average in this overall score right here is 100. Okay. Sioux Falls, when I took the snapshots, national average was, their average overall score was the same as it is overall nationwide. From there, you can see how much different things cost and what the total cost of living is from that normal or from that average. The website will also tell you a salary of $50,000 in Sioux Falls, South Dakota, should increase to $55,000 in Denver, Colorado. Again, in the concept of managing income, you can better take into account what you should be receiving if you're going to be required to move. All right. That'll be the next video. The last thing we're going to talk about in managing income is touch on a little bit on taxes. And one of the things that I want to touch on is South Dakota is, I think it's one of 5 states, if I remember correctly, in the United States that doesn't actually have an income tax. We have property taxes here. And while we're talking about income taxes, and you want to take that into account when you're looking at different places to live. That salary calculator, though, you'll notice doesn't take that into account. So that's another one of those add-ons. Now, we're not going to do it for this project, this Project One portfolio, but you will want to do it when you actually start looking at maybe different places to work. So don't forget that. And while we're at it, we have 2 types of taxes that we're concerned about in here. The first is income taxes. I know it's second down here. And that is simply a tax on your income. And we have federal income taxes. And in most states, we have a state income tax. Again, in South Dakota, we don't have one. We have property tax. The other type of tax that we're going to be concerned about, and I'll be talking about in here, is something called a capital gains tax. And to illustrate this idea, I want you to think of buying a house for $100,000 and then selling it for $120,000 after living there for a year or 2, well, more than 1 year. And when you do that and you own an asset and then you sell it at a higher price than what you paid for it, you have what's called a capital gain. So in this case, $20,000 would be the gain from the house when you bought it and gaining $120,000 when you sold it. You're taxed on that $20,000. And in 2015, this was actually changed. The maximum you can be taxed on a capital gain is about 20%. 5 years ago, the maximum was 50% or 15%. So there was a lot of incentive to try to get a lot of capital gains versus income. Warren Buffett, one of the wealthiest men in the world, was complaining a while back that he actually paid less in taxes than his secretary. And his secretary actually had a higher income than him. He paid her something like $115,000 a year. But working for his mutual fund, Berkshire Hathaway, he only received a salary of $100,000. So where did most of his money come from? It came from capital gains taxes, or that's where that money, it came from the selling of capital items, such as stock. So he had a much lower overall tax rate than his secretary. So again, these are the 2 types of taxes we're concerned with. Is one, capital gains, and income taxes is the other. Now, if you buy and sell an asset within 1 year and you have a capital gains, then you're actually taxed as income. So, and I believe the maximum tax rate right now is somewhere around 40% for the top tax bracket. Hope this helps, and the next thing you'll want to get into is your Project One portfolio, and you should have explanations in there. Thank you, and have a wonderful day.